Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course to make it actionable, understandable, and clear. What a week. Whew. What a show. Kind of felt like the Texas Giant. I went to Six Flags not so long ago, and you get on these rides, and you end up right where you started, but boy, a lot of ups and downs in the interim. That's what this week felt like in the markets. We're going to look at some excellent data points to keep you level-headed, keep you sharp, hopefully help you learn something. We're going to be looking at a story that I created for you, the listener, the Vanguard dividend story for their S&P 500 ETF versus their total stock market ETF. Why was there such a discrepancy in the dividends? I'll tell you how that went. I called Vanguard and had a good discussion about it. We're then going to look at an excellent CNBC article that Warren Buffett is featured in that talks about what he does in times of calamity. We'll look at one of our favorites, Mr. Peter Mallouk. Wouldn't you suspect it? He came out with some great data points on the X platform that are good reminders in these times of volatility. I'll probably opine on tariffs, but there's nothing on the run sheet. The producer's just letting me run free this week. And then a couple other good quotes, but we'll start out with that personal story whereby I was just confounded. You know what I always tell folks. Hey, investing's like farming. Don't treat it like a casino. Treat it like a farm. And for you urban folks who've not raised crops on a farm or suburban, you don't need to focus myopically on the price of your farm. Let's say you have a 100-acre farm. It produces corn and soy and wheat. You care about the productive capacity of the farm, not what your neighbor is yelling at you each day in price quotes. That's effectively what the stock market does for us. Well, I was confounded because Vanguard has these two exchange-traded funds that are very popular. One, ticker symbol VOO, which is the S&P 500 ETF. One is VTI, which is Vanguard's total U.S. stock market ETF. They're almost identical indices. One is every stock basically in the stock market, VTI. One is the 500, the S&P 500. But VTI, that total U.S. stock market index, 80% of it is comprised of the S&P 500. So they basically trade the same. Their dividend growth rates should basically be the same. Their dividend yields are identical according to the SEC. They're pretty similar. However, and you'll remember this from last week, you faithful listeners, the VOO ticker, the S&P 500, from a year over year, Q1 to Q1 of 2024 to Q1 of 2025, the dividend increased 17%. That was bananas. Shouldn't happen. Wait, wow, what happened? And then when you pop over to VTI, the total U.S. stock market, it only increased about 7-8%. Something doesn't smell right. Because you're a faithful listener and because you listeners deserve the best, I said, I'm going to figure this out for you guys. I called Vanguard, called them today. Their kind of advisory group didn't have any answer or knowledge of it. No surprise. No one's calling about this discrepancy, but we are. They then sent me over to the fund specialists. These are folks who specialize in the Vanguard products. They were great. Everybody was great. They said, hey, well, let us research it. They researched it for an hour, call me back. We can't make heads or tails of it. We recommend you write a letter to the specific person that manages the fund and ask them the question about the discrepancy. Now to that, I just thought that sounds like file 472 in the U.S. government's box. Maybe I'll do it just for the sake of the show, but it was a reminder to me that it really is a black box on the kind of advice side for Vanguard, that the fund and this is what the sweet person on the phone said to me, hey, the fund spits out the dividend. It pays out. We publish it. That's it. Like, they basically get the news. They don't have any phone. They cannot pick up the phone and call those fund managers. So we don't know, guys, and neither does Vanguard. Isn't that bananas? Isn't that wild? And they acknowledge the discrepancy and they acknowledge the similarity in the funds, but they said, we don't know, and they don't have a bat phone to call the fund managers. It requires me, or maybe you, one of my faithful listeners, wants to write. We should all write. Let's all write. So it's a mystery. I don't know why, but that was the answer. And Some of you followed up to say what happened. So here I am faithfully telling you, I still don't know. But now that we're forced to go with snail mail, who knows when we'll get any sort of clarity. Let's talk this volatility. I think in my 39 years of life, I don't recall this sort of volatility. Now, you got to be careful because that recency bias, that idea that what's happened in the most recent past, I anchor to and I think is more important than what's happened in all of history. Very dangerous. But just so you know, listener, the swings based on one person's tweets via Truth Social, which I guess gets reposted onto the X platform. Very confusing to me. President Trump, as he opines on trade policy, the market has had these demonstrable moves. Now, if we had just been ostrich investors, and hopefully you were, and you didn't do anything, or maybe you didn't see anything. This is, admittedly, I'm recording this after market close on Thursday. What would you think the market did for the week? American stock market this past week. What would you think it did? Well, it's about flat. Not wild. It's about flat. Now, the U.S. stock market for the past month is down about 6%. The past 3 months is down about 10%. So, but this week, that week was just felt wild because the Trumps are on it. Trump said the tariffs are on. Oh, the tariffs are off for everybody but China. Boom. And yet now, today, the whiplash is wild. So, flat. Can you imagine that? Flat for the week, despite all those shenanigans. International markets, slightly down. You could call it flat, but down 0.63% in the last week. That's going from, I guess, April 4th to April 10th. So it's including Friday's action. But again, kind of flat. That can happen. And that can happen in years, by the way. Year to date, oh goodness, you're down. But over the last year, what do you think the American stock market's done over the last year? 365 days? Flat. Flat. Can you even imagine? International markets over the last year, almost flat. Down about 1.75%. So amidst the turmoil, potential carnage for the steady Eddie investor that's not using leverage on their investments, nothing to talk about. Now, we're going to be watching these dividends like a hawk because we're farmers, not speculators. So we're going to see, hey, will these earnings get hit by these various tariffs and the uncertainty that's created by them? Maybe. But let's also talk about what to do. You ever hear that? What do I do? Well, I've got some quotes for you. But we'll first start with Mr. Peter Mallouk. He says, and this is, people oftentimes wonder, hey, if you're in cash right now, hey, how do I get in the market? A lot of people, hey, do I dollar cost average? There's a little bit of choppiness here. Do I dollar cost average over a certain time period? Do I go lump sum? Meaning, if I've got cash, I just click the button, all in, done one time. What do I do? Mr. Mallouk asks this question: what are the historical odds that dollar cost averaging into stocks over 12 months will beat lump sum investments? I'm going to ask that again. What are the odds that dollar cost averaging, that idea that you're going to put in a certain amount of money consistently over a period of time, over 12 months, will beat lump sum investing, which is it's only 32%. So most of the time, dollar cost averaging loses to lump sum investing. What about over 36 months? It gets worse. Dollar cost averaging, only a 26% chance. So when people ask me, hey, should I dollar cost average or lump sum invest? I say, well, the evidence-based investing, which is what we try to be, evidence-based, not emotions, says lump sum. I'd add one more caveat. Lump sum, it does outperform 74% of the time over a 36-month period from 1928 to present, but it's also easier to execute on. It is a consistent problem that I see that, oh, great, I'll dollar cost average over, so many months. I forgot to do it for this month. Do I do a double? All of a sudden, you'd think it'd be easy. It's really not, especially when market calamity occurs. Well, maybe I do more of this. Maybe I do more dollar cost average. Maybe I do less. I think lump sum investing is the way to go. It typically spooks people when I say that. It's simply what the data tells me to do. So Mr. Mallouk also has a great data point here. He says during periods like today with heightened fear and volatility, he's referencing one of these individual days in the last 5 days where it's just not, market's going crazy. It's tempting to think you can get out of the market and get back in when the coast is clear. You ever heard that? Like, hey, look, I'm just going to let the dust settle here. Let's let Trump be done with the tweets, and then I'll get in. But he reminds us correctly that the problem with this is the time the coast is clear, many of the best days and biggest gains have already passed. So true. So he lists out these various dates and the total return over the next 12 months. So he basically shows the date where the bear market bottomed and then what happened in the next 12 months. The returns are, no surprise, outstanding. June 13th, 1949 was a bear. October 22nd, 1957, June 26th, 1962, on and on and on and on. And it shows all these. You'll remember this one, March 23rd, 2020. That was the COVID low. What about March 9th, 2009? Aha, great financial crisis low. What about October 9th, 2002? You remember that one? Tech stock bust. Over the next period, let's just take COVID. Over the next 12 months, the S&P 500 returned 77% from that March 23rd, 2020 low. That's how good you have to be. And you will miss out on that if you're waiting for the coast to be clear. Wait for it to be clear. See if it's okay. August 12th, 1982, you're up 66% from the bottom. So you'd really have to get on that train quick. These are over the next 12 months. These returns are over 12-month periods. So they're huge returns. Usually, I'd say the average is about 45.8%. So whenever these lows happen, the next 12 months, and you don't know when they happen, by the way, right? I wish we did, right? We would just pick low points and play bocce ball. We can't do it. 45.8% is the return you get. So don't overthink this. Don't try to be smart with it. Recognize your limitations. That's a really important thing. And then you knew I'd come out with the quotes. This is, I don't even know how to reference this. This was actually, I thought it was a kind of a junk email, but they mentioned the word Bogle. And so, of course, I come a-running. They say Bogle, and referencing Mr. John Bogle, the founder of the Vanguard Group, who popularized the index fund in 1976. He had this quote. Bogle did, the late John Bogle. He says, "My rule, and it's good only about 99% of the time, so I have to be careful here. When these crises come along, the best rule you can possibly follow is not don't stand there, do something, but don't do something, stand there." Did you catch that? Normally you hear this, don't stand there, do something. He says, no. It's don't do something, stand there. It's do nothing. It's very hard to do nothing. Very, very hard to do nothing. But Bogle, as only Bogle can, just puts it beautifully. Do nothing. Do nothing. So this email kind of talked about rebalancing and how often you rebalance. A lot of people are asking about that. I wouldn't just do anything. I think in these times we've got enough emotions going and fears that I like rebalancing schedules to be more time-based. Rebalancing is the act where, hey, I've got more stocks than bonds, more bonds than stocks, so I'm going to sell my stocks when they're going good and buy bonds, or hey, when the market's crashing, I'll sell bonds and buy stocks. All good. Can be a fine thing. I don't like human beings using any sort of their emotion to make those decisions. I would prefer you do that once every 5 years if you need to. Sometimes you can rebalance by adding new monies to your investments. If you're in a taxable account, it limits your taxes. So be careful. I just think I would say be careful. I wouldn't make any major moves during this time unless, of course, you've got cash to invest. Then I would just close your eyes and click the button. But if you're already invested and people are telling you to do stuff, just remember what Jack Bogle said. Just stand there and do nothing. Nothing. And then our CNBC article. I thought it was excellent. They're not always excellent, but this is Mr. Ryan Ermey. Headline, "Keep Your Head. If you're spooked by tariffs, Warren Buffett once suggested reading a 19th century poem when stocks fall." So I'll read this poem. This is by Rudyard Kipling. I guess his poem was, classic poem, titled If, from 1895. "If you can keep your head when all about you are losing theirs, if you can wait and not be tired of waiting, if you can think and not make thoughts your aim, if you can trust yourself when all men doubt you, yours is the earth and everything that's in it." Now, you and I both know that the earth is the Lord's and everything there in it. And blessed are the meek, for they shall inherit the earth. However, you know the point he's getting at. Mr. Kipling, what he's trying to convey to you is that keep your head. Keep your head, because you will be in rare air if you do. It's hard to do. Buffett, this is a 2017 letter to shareholders, says this. He says, there is simply no telling how far stocks can fall in a short period. Boy, isn't that true? He has another quote I like. The light can at any time go from green to red without pausing at yellow. Now, this is why I think we should be so very careful anytime we're using leverage to invest in a security like a stock that has a lot of volatility. We should be so careful that our personal balance sheets are resilient enough to endure anything that's happened in history, because there's no rule that says something far worse can't happen. I'll tell you personally, the more I read, the more I think, oh yeah, this can go as bad as anyone wants it to go. There's no rule that says the intelligentsia will figure out tariffs. In the same manner, there was no rule that said in 2008 and 2009 the great financial crisis would be solved. It didn't have to be. We saw in the late 1920s, early 30s, there really wasn't much of a solve. In fact, a lot of harm was done. So we can't control a lot here, meaning let's control what we can. That's not a cue for the outro just quite yet. I'm telling my producer, no sir, hold on. Stay, hold on. I would just say this is a great exercise. We're certainly in the gym and we're training and we're sparring here with this market volatility. And we all can, in a sense, convince ourselves that our risk tolerance is very high. We can endure quite a bit. These movements, though, what the great reminder here is these movements, they don't happen in a laboratory. We can look back at the stock chart and just kind of chuckle and say, I can't believe people would sell there at the bottom of 2009. Smart people did. That's what a stock market sale is. Same number of buyers and sellers agreeing on a price. So at March of 2009, people did. March of 2020, people traded. Smart people with money traded. It didn't happen in a vacuum. It's easy to look back and say, oh, I can't believe they did that. But just think about how you feel right now. There's no, again, like I said, there's no rule that said these tariffs can't run anyone off the cliff and that we might have a lost decade or two. No rule. I don't think that should be our baseline case, but it's a possibility. So we can at least understand why perhaps folks in history and why we too might be victims of this. If the headlines get bad enough, and oh, by the way, sometimes the headlines are true, and oh, by the way, what if business grinds to a halt? We enter a big, deep recession. There are defaults. Jamie Dimon came out and said he thinks credit's going to have some problems. These private credit funds apparently are in really tough shape. A lot of the private equity space is kind of delaying the pain, but eventually it's going to hit. I don't know. Maybe it's nothing burger. Maybe it's something. But let's remember, these dips don't happen in isolation. Therefore, let's focus on what we can now. Keeping those costs low, that investing simple, and your time horizon really long, because that's what's going to give you the best shot on your investing journey. Until next time.